Welcome everybody. Pitcher Partners and McMahon Clarke are delighted to host this Compliance Committee Forum presented on behalf of the Independent Compliance Committee Members Forum for both Sydney and Melbourne. I would first like to thank both Cliff Clayton and Paul Dortkamp for the opportunity on behalf of Pitcher Partners and McMahon Clarke to be able to host this presentation. This webinar is a first for the Compliance Forum and we hope you enjoy this new format. Today we have close to 400 registrations and we're very glad you're able to join us. With the current economic climate, the corporate regulators are rethinking their corporate priorities, their strategic priorities. As a part of this, there's a raft of new regulatory and compliance issues ahead for the financial services sector. Today, we'll provide a briefing on the key priorities in ASIC's new interim corporate plan and other topical updates about disclosure obligations, valuations and unit pricing, and the challenges and obligations for AFS licensees. This regulatory update will be provided by McMahon Clarke. This will be followed up by a tax update analysing the latest developments for managed funds, including key issues related to COVID-19. The tax update will be provided by Pitcher Partners. Before we start, I'd like to provide a bit of background to today's presenters. McMahon Clarke is a niche practice focusing solely on funds management and real estate industries and provides legal services across the life cycle of a real estate or funds management investment and structuring and establishment through to exit strategies and disputes. McMahon Clarke is consistently and independently ranked as leaders in investment funds Australia-wide in Chamber Asia Pacific. Matt Moses is Special Counsel in McMahon Clarke's funds management team, where his focus is complex project and transactional work, structuring and establishing investment funds and financial products, and all aspects of fundraising, ongoing operations, governance and compliance. Matt has genuine on-the-ground experience, having worked as in-house legal counsel for some key industry players, including a leading residential property funds and real estate services group. Elliott Stumm is a senior associate in McMahon Clarke's funds management team. Elliott has a specific focus on the AFS licensing regime and advising retail and wholesale fund managers and other AFS licensees on establishing and operating their financial services business, as well as establishing, promoting and operating investment funds. The tax update provided by Pitcher Partners will follow. Pitcher Partners is a trusted advisor to middle market businesses across the country. We provide accounting, audit, and advisory services drawing on personal understanding and involvement in each client's affairs to provide tailored solutions. My name is Alexis Kokkinos. I'll be providing the tax update. As background to myself, I have 25 years of experience in providing taxation advice, specialising in funds management and investment services. I've been previously involved in the development of the AIMIT and CCIV regime through the Board of Taxation and Treasury, and I'm currently a member of the ATO NTLG, National Tax Liaison Group, and the chair of the CPA's Tax Centre of Excellence. I will now hand over to Matt Moses and Elliott Stumm to commence their presentations. Thank you.
So thanks, Alexis, and thanks, Pitcher Partners, and thanks to the forum for having us. Welcome, everyone. Thanks for attending, or virtual attending, or whatever the correct term is at the moment. Particularly welcome those like me who are down here in the COVID capital of Australia at the moment, down in Melbourne. So what are we going to talk about? Firstly, I'm going to talk about some interesting insights from an interim corporate plan recently published by ASIC. And then my colleague Elliott will talk about some current challenges and obligations from a licensing perspective in the current environment. So why are we looking at ASIC's interim corporate plan? The reason is it's short, but it gives us some useful insight into the regulator's immediate priorities in the current environment. You might ask, what is ASIC's annual corporate plan? It's not something that you necessarily hear about. You may not have seen one, but it's a plan issued by the regulator each year where it sets out how they're going to meet their corporate objectives, usually over a coming 4-year period. ASIC published its last plan in August last year, and now COVID's obviously turned the world on its head, so to speak. So on the 11th of June this year, ASIC published an interim corporate plan for this year and next year with some short-term priorities listed in it. Now, ASIC has listed 5 main immediate priorities in there, which I won't go through given the time frame, but The main focus is really on consumer protection. ASIC says that there are heightened consumer and corporate vulnerabilities, it thinks, as a result of the COVID-19 pandemic at the moment. So again, its main priority seems to be on protection of consumers. I won't go through all the points in the plan, just some key ones. The first one I'll talk about is advertising, including websites. So advertising has been one of ASIC's biggest focused areas in recent times, even pre-COVID. That'd probably be apparent to anyone who's kept an eye on the financial press in recent times, including ASIC's own media releases. So if you read the plan, taking action in relation to false and misleading advertising seems to be a recurring theme in the context of ASIC's desire to protect consumers, particularly at the moment. And in fact, a few days after it released the plan, ASIC published a press release in which it said it put all responsible entities and managed investment schemes on notice that, sorry, I'll just make sure I've gone to the right slide whilst I'm talking. Put all REs on notice that they must ensure their investment fund advertising provides clear, balanced and accurate information. ASIC said it had already carried out some risk-based surveillance of advertising websites and PDSs from various managed funds in the current environment. Said it was concerned to find some funds were promoting or providing inadequate information or not accurately and clearly presenting key features of their products. So ASIC said that 7 REs were warned, in its words, in relation to at least 13 funds. And interestingly, just here are some examples of the concerns ASIC said it had when it looked at some advertising and websites. One concern was unbalanced comparisons. So comparisons focusing on one aspect of a product or a fund, like higher returns, without providing a fair and balanced indication of key differences and risks. Another area is safety and stability representations, which are ASIC's words, which it says is promoting funds as having little or no capital risk, loss risk, despite the fund's underlying assets being subject to considerable risk and market volatility. Another area is withdrawal representation, so giving the impression to consumers that it might be easy to withdraw from a fund on short notice. ASIC says it's aware of a number of funds promoting that their products are as high yield or low risk when this may not be the case. A recent high profile example you've probably seen, there's been a lot of press on it, including today, I notice, is on the Mayfair and Mayfair 101 group of companies. You've probably seen ASIC's taken various action in relation to that company and group, which has various products, but the main product they seem to be concerned about is a note product, a debenture product, where they say the group has favourably compared their product to bank deposits. You might think that Mayfair is a bit of an outlier in terms of what they might have been doing or saying, but we can tell you that's not the case, because a couple of very long established fund manager clients of ours received similar letters of concern from ASIC in relation to advertising. They mainly took issue with comparisons sorry, I've just lost my train of thought there, comparisons to cash products and references to product stability. Now, ASIC has taken issue with these sorts of things, rightly or wrongly, but it does seem to be a big area of focus for the regulator at the moment. Another area which is similar that ASIC talks about in its plan is concerns about the labelling of funds. ASIC's concerned at the moment to make sure funds are what it calls true to label, and this sort of concern clearly has risen from the Mayfair type situation. Again, ASIC's concern about advertising that in any way compares for example, a fixed term investment product or bank deposits and similar products with liquidity. So what are some tips in relation to advertising? Might seem obvious, but it's a good idea to push for all advertising to go through a rigorous review process and get external review if needed. Take a look at ASIC Regulatory Guide 234, Advertising of Financial Products, which I won't go through at the moment, and particularly avoid statements which might be construed as comparing your funds or products favourably to other products, particularly products in other investment classes, and avoid phrases like, for example, safe or secure investment. Now, another area I'll touch on briefly that ASIC talks about in its plan, which has been another ongoing area of concern for ASIC, is monitoring adherence by listed and unlisted companies and funds with continuous disclosure obligations. So ASIC has had a number of releases which put companies on notice in the current environment that they will be taking a pretty close look at continuous disclosure and lodgements, and has had a bit to say in that regard, but I won't go into that in more detail given the time frame. Another area that ASIC talks about is concern at the moment about resilience of managed funds, including REs. So if you read the plan, ASIC, you can see ASIC obviously expects that there will be some responsible entity or fund failures coming out of the current COVID situation. Insolvency of funds and REs is a bit of a messy area from a legal perspective. There's been a lot of commentary in that regard over a number of years, going back to the GFC and before that. Despite that, there hasn't been much regulatory progress or legislative change in the area of insolvency of funds, but ASIC says it's continuing to work on what it says are contingency plans, allowing it to effectively respond in the event of a fund collapsing or an RE collapsing. And in fact, in March, it sent a letter to all REs just reminding them to monitor their fund liquidity and asking them to notify ASIC if any registered scheme becomes non-liquid. So we've talked about various areas mentioned in the plan that are focused towards, I suppose, consumer protection. Another area I'll talk about, which is touched on a bit in the plan, is valuations, a particularly interesting topical area at the moment. Valuations, a lot of people listening are probably focusing on valuations at the moment, and of course, who would want to be a valuer of hard assets at the moment? There's pretty uncharted waters for valuers and managers of these sorts of assets at the moment, and therefore it's an area ASIC says is of interest to it and an area it will focus on. It says in the plan it will identify schemes where assets are not being appropriately valued or there is misconduct arising from valuations. I'm not quite sure what that means, misconduct arising from valuations. But anyway, it is an area of focus. So if you think about unit pricing, it's obviously a function of value. You can't price units in your fund without knowing the current values of the underlying assets. If you don't know the value of underlying assets or there's some uncertainty, then unfortunately you shouldn't really be issuing any new equity in your fund or allowing withdrawals at the moment, even in an emergency fundraising type situation. So what are some principles just quickly in this area that you can look at? It's important to note that fund trustees, like all trustees, have various trustee duties, including to exercise due diligence and vigilance, and to not delegate trustees' duties or powers. Now, those sorts of duties flow into the valuation of assets, particularly in the current environment, and also unit pricing. So some tips in that regard that it might seem obvious, but it's important, particularly at the moment, to get independent expert evidence of value of your underlying assets, which most people would do. But that's actually not the end of the story. It's important to review valuation reports in detail to ensure that the valuation is not highly qualified and that the assumptions used by the valuer are in fact reasonable. The reason for that is there's been cases where courts have actually found in the past against trustees who have relied on independent advice because the advice received was so qualified that no reasonable trustee could have relied on it. It's also important to ensure your unit prices are calculated strictly in accordance with your pricing policies and other policies at the moment, particularly valuation policies. And lastly, ensure that these processes, particularly around valuations and pricing and trustees' decisions, are carefully recorded and evidenced at the moment for future purposes. It's a particular area of importance at the moment. Now, moving on very quickly before I finish and moving on from ASIC's interim corporate plan, ASIC, there's other measures that ASIC brought into place when it started to get a handle on the COVID situation a few months ago. It came out and announced various relief measures to help businesses navigate some of the current issues, including giving relief to help listed entities raise capital quickly using so-called low doc type offers, which it also did during the GFC. It also announced a no action position in relation to deferring annual general meetings for listed companies and also for managed investment schemes. There's various measures like that have been reported on in the press in recent times. So ASIC's done a few things in relation to the current environment and says it's continuing to monitor the current environment. And lastly, just a quick update on the new product design and distribution obligations, which I think we've talked about in this forum for a couple of years. Those obligations are due to come in, or were due to come in April next year, 2021, for fund managers and other product issuers. They've now been delayed for another 6 months to 5 October next year. So there's a bit more time to get ready for those, but as we're starting to do some work on that at the moment, there's a fair bit to do, probably more than some people think, in preparing for the implementation of that regime. So I hope that's provided some useful, if not fairly brief, insights into the regulators' current thinking. I'll hand over to my colleague Elliott now to talk about some current issues from a financial services licensing perspective.
Thank you, Matt, for that, and thank you, Alexis, for your introduction earlier. As Alexis mentioned, my name is Elliott Stumm. I'm a senior associate in McMahon Clarke's funds management team, and my specialty is in the AFS licensing regime. And what I'll be talking to you about today are two things. So firstly, some of the challenges faced or which could be faced by licensees with respect to their obligations in the context of the COVID-19 pandemic, but also going forward. And secondly, the fit and proper persons test, which is now required to be satisfied by AFS license applicants, and the relationship between the concept of an officer of a company and its responsible managers. So in terms of the challenges faced by AFS licensees in the context of COVID, I appreciate the degree of restrictions currently in place varies around Australia, and I mean the restrictions impact businesses differently depending on factors such as the nature and scale of their business. An example of that being a financial planning business with a large number of representatives who would normally deal with clients directly. That sort of a business is more likely to be severely impacted by the government restrictions than a business that operates online. However, I expect some of the challenges I'll discuss will be relevant to most licensees now and going forward, including in the post-COVID world, whether as a result of changes in human behaviour that have sort of been accelerated due to the government restrictions, such as an increase in remote working arrangements, or as a consequence of the state of the economy that we'll find ourselves that we're in or will find ourselves in the short term. So as a starting point, all AFS licensees are required to maintain compliance measures that are designed to ensure they comply with the financial services laws. And in maintaining these measures, it's important that AFS licensees consider the challenges faced by them in the context of COVID-19 and the impact they may have on their ability to meet the general obligations and adjust their compliance measures as required going forward. So in fact, COVID-19 for some licensees may have revealed some shortcomings or issues in the procedures that they've got in place and may have prompted them to update them. So if your compliance procedures are inadequate, it's important that they're reviewed and updated so that they're compliant and appropriate going forward. In the past several months, as part of their assessment of AFS license applications and variation applications, ASIC have been issuing COVID-19 questionnaires, which are designed to seek information as to whether an applicant's approach towards ensuring compliance has changed as a result of the government's response to COVID-19. And if they have, why its new arrangements are adequate, and if they have not, why its existing arrangements are adequate. So everything that I've said so far is really to contextualize some of the things that I'll now talk about. So the first thing I want to mention is outsourcing. In the context of an AFS licensee in complying with its obligations, it's a responsibility of the licensee to ensure not only that it has adequate procedures and arrangements in place in the context of COVID-19, but also those of any service provider that is engaged as part of its financial services business. So it's important that licensees monitor and supervise their service providers to ensure that they can continue to provide their contracted services and meet their obligations. In the COVID-19 questionnaire that I mentioned, ASIC is giving out in their assessment of applications, ASIC is specifically asking applicants to identify external service providers and state whether the applicant for the license has made inquiries as to their COVID-19 arrangements and as to whether or not they're satisfied that those arrangements are adequate. So as I'm sure you'll appreciate, a number of service providers have gone out and contacted AFS licensees that have engaged them and provided them with an update on either their COVID-19 procedures or business continuity plan. For those of you that have received that sort of information, AFS licensees, we'd suggest you document your consideration of those arrangements and whether you're satisfied that they're adequate and will enable those service providers to meet their obligations. And if you haven't already done so, or you haven't received information from service providers that you utilize as part of your business, AFS licensees should reach out to their service providers and obtain information as to how they're ensuring they can continue to meet their obligation as part of the licensee's monitoring and supervising of its service providers. So another area in which AFS licensees may be challenged in the COVID-19 environment is in the monitoring and supervision of representatives. So the shift towards working from home means some representative of licensees that previously operated out of the principal place of business and were previously operating under the direct supervision of directors, responsible managers, and senior staff are now effectively operating in an environment without the physical presence of supervisors. And this impedes the ability for the senior members of staff to effectively oversee and supervise their representatives and ensuring that they comply with the financial services laws. So it's important that when you are looking at your compliance procedures, you consider whether any changes are needed to enable your representatives to be appropriately monitored and supervised in the current environment. And what that will involve will necessarily depend on the type of business carried out by the licensee and other matters. So another broad area in which licensees could be challenged in the current environment is in maintaining adequate resources to carry on its business in compliance with the law. So the COVID-19 pandemic and government restrictions have obviously put pressure on AFS licensees' resources, just as it has the resources of other businesses and different industries around Australia. For licensing purposes, there are three types of resources that you need to make sure are adequately available. So human resources, technological resources, and financial resources. So human resources could have been adversely impacted if a business has, for example, needed to reduce the number of staff that it has to reduce costs. So it might be that as a consequence of the current environment that a licensee no longer has sufficient human resources to meet its obligations. Technological resources is a pretty big issue in this sort of environment for financial service providers, because we're all just as an example with this compliance committee forum, we're all operating digitally, whereas we previously would have done a lot more human contact and personal meetings. So having adequate technological resources available to an AFS licensee is really crucial to ensure that they can effectively function and carry on in the current environment. And the last type of resource that I listed is financial resources. So it's important that licensees have a think about whether the cash flow projections that they've prepared over, let's say, the next 3 or the next 12 months continue to be accurate in light of any revised projections around income that they may receive or expenses that they may incur. And it's important that those cash flow projections are updated to ensure that a licensee can make available to itself adequate financial resources to make sure it meets its obligations. Okay, so the last area that I'll sort of quickly touch on before moving on is this concept of risk management. As I mentioned before, we're all working in a much more digital world at the moment, and what that has meant is that AFS licensees are far more susceptible to cyber attack and cyber incidents. So one thing that AFS licensees should really be looking at in this current environment, and that's something that ASIC has been looking at for some years now, is making sure that they've got a cybersecurity risk management and cyber resilience procedures in place. So you should have a framework for managing cyber risks that's designed to ensure that the business is not unduly exposed to risks and provides for an organised approach to managing cybersecurity incidents and enables the business to have a coordinated response and resolution of any such incidents should they occur. So the last sort of thing that I'm going to talk about today is this fit and proper persons test. So as some of you will know that from February this year, if a company is applying for an AFS license or if it's applying to vary its license, before it will be granted its license, ASIC needs to be satisfied that the applicant is fit and proper to provide the financial services that it's seeking to have covered by its license, and also that its officers and controllers are fit and proper as well. So prior to the introduction of this fit and proper person test, ASIC was required to consider whether it had any reason to believe, required to consider whether it had no reason to believe that the responsible officers of an applicant were of good fame and character. So a responsible officer is a more restricted term, or was a more restricted term than the term officer. And a responsible officer was essentially an officer who would perform duties in connection with the holding of the license. So given the responsible officer test has been replaced by this fit and proper person test, what we're essentially seeing is a broadening of the types of people that ASIC are going to be assessing when considering whether or not to grant an AFS license. So central to this sort of concept of fit and proper people is this idea of who is an officer of a company. And it was confirmed by the recent High Court decision of ASIC and King back in March that for the purposes of the Corps Act, an officer includes people who hold certain named offices with prescribed duties and functions, such as a director, a secretary, a receiver, an administrator, and other types of people. However, the term officer is obviously not then limited to those who hold or occupy a named office or a recognised position with rights and duties attached to it, but it also captures people who, a person who makes or participates in making decisions that affect the whole or a substantial part of the business. It also captures people who have the capacity to affect significantly the company's financial standing. And it also captures a person on whose instructions or wishes the directors are accustomed to act, excluding certain advice given by people like professional advisors. So going back to this fit and proper person test, when a company is applying for an AFS license or looking to vary an AFS license, ASIC now requires the applicant to provide a declaration confirming who their fit and proper people are. And in terms of those people, an applicant's also required to provide certain information about them, as well as a criminal history and bankruptcy check and a statement of personal information generally. So what I've sort of summarised so far is how ASIC assesses whether an applicant is fit and proper. The next part that I'm just going to talk about is how ASIC assesses whether an applicant meets the organisational competence obligation. And it does this by assessing the knowledge and skills of an applicant's responsible managers that they've nominated. So a responsible manager is essentially a person that's nominated by an applicant or by an existing AFS licensee as being directly responsible for significant day-to-day decisions about the ongoing provision of the financial services. So to be a responsible manager, you need to meet that threshold, and you also need to meet the options contained in ASIC's Regulatory Guide 105, and you need to be a fit and proper person. So when you're going through the process of nominating a responsible manager, you have to describe the relationship between the applicant and the responsible manager as falling into one of three broader categories. So one is an employer and officer, the other is owner or partner, and the third category is as an external service provider. So it has long been recognised by ASIC that a responsible manager doesn't have to be and is not necessarily an officer of the company. However, given that AFS licensed applicants are now required to provide a declaration as to who its officers are, I sort of expect that ASIC will begin querying the absence of any responsible manager from that declaration who's being heavily relied on by the applicant to demonstrate its organisational competence. And that's just because of the, I guess, the surface level similarity between the definition of an officer as including a person who makes or participates in making decisions, and the definition of who can be a responsible manager, which includes a person that is directly responsible for significant day-to-day decisions. So for most responsible managers, falling within the definition of an officer will be of no surprise and will probably be of no issue. And you know, the sorts of responsible managers I'm describing there are those that hold a senior internal position in the business, like a CEO. However, for other responsible managers, such as an external service provider contracted to provide responsible manager services, falling within the definition of officer would subject them to the burdens of the provisions of the Corporations Act with respect to officers, which include duties and civil penalty provisions, which may not have been contemplated by them in agreeing to and negotiating their arrangement with the licensee. So ultimately, whether a responsible manager is an officer of a company is a question of fact, and being nominated as a responsible manager itself doesn't result in a person being an officer. However, if an external responsible manager is being nominated and it is not intended that the person be an officer of the licensee, then it's important the terms of the engagement clearly outline the role, responsibility, and level of involvement of the responsible manager in the company's business. And the responsible manager does not exceed those sorts of things, so that it can be said that on the one hand, the responsible manager is directly responsible for significant day-to-day decisions about the ongoing provision of financial services, so that they are eligible to be a responsible manager, but at the same time that that person does not make or participate in making decisions that affect the whole or a substantial part of the business of the company, so as to make sure that same person does not fall within the definition of an officer. So if those sorts of things are clearly dealt with in the terms of engagement, then this will assist in facilitating an applicant in demonstrating to ASIC, you know, why a responsible manager was not in, is it not or will not in fact be an officer, and therefore why they weren't named in a fit and proper persons declaration. So that was a very quick and sort of high-level overview of the fit and proper persons test, and also some of the issues facing AFS licensees in the current environment. I'll now hand over to Alexis, who will be talking around some of the tax issues for managed funds.
Great, thank you very much, Matt and Elliott, for that very informative presentation. I'm now going to go over our tax update, and from a tax perspective, I'm just going to cover two specific areas through this session. There's limited time to go through a lot of things in detail, so I'm just going to touch on some items. Hopefully a lot of these items you've already dealt with, but to the extent that they are issues, then hopefully this will trigger your ability to look at them. So the two areas I'm going to cover is, the first area is on COVID-19 related items. So I want to specifically cover those for the 30 June period, 30 June distributions and tax calcs. And then I also want to just give a quick update on some other measures that are coming into effect that you should be aware of or should be looking at the moment. So going through COVID-19, and the first area I want to just touch on just really quickly is JobKeeper for the trustee or management entity. Now, hopefully most of you have already gone through your assessment of JobKeeper and are either have qualified or you're already going through that process. Now, for those that haven't gone through that, obviously 30 June is a big period for many trustees or management entities, because that's where you'll be calculating your performance fees, or would have booked through your performance fees for 30 June 2020. And it's the opportune time for you to have a look at exactly what your turnover is to determine the decline in turnover test for the JobKeeper rules. To that extent, there's two things that we'll just highlight here. Excuse me. To the extent that you have been claiming JobKeeper and you did a projection of what your management fees or performance fees were going to be, it's probably a good opportunity for you to have a look at what your budgets were in comparison to what your actual fees were, to see if you've overestimated or underestimated those amounts in respect of the JobKeeper claims. It shouldn't change the validity, but if you're substantially underestimated the amount of your turnover, there could be risks associated with that. For those that haven't claimed JobKeeper, obviously it's a good opportunity for you to now have a look at JobKeeper for those management entities. There are still 6 fortnights left with respect to JobKeeper, which equates about $9,000 per employee that you may be able to claim if you meet the requisite turnover threshold decline and all the other requirements of JobKeeper. I'll also just note that the ATO has commenced its reviews for the JobKeeper claims. So it's publicising those as we speak, and they are starting to look at people's claims. So it's, again, to the extent that you have been claiming JobKeeper and your final figures are coming through, it may be opportunity for you to have a look at what those are to check the risk of ATO challenging your JobKeeper claims. Okay, so one of the critical items we've been seeing for the 30 June distribution reviews has been the treatment of income by a number of the managed funds, especially due to what we would say considerable differences between accounting and tax treatment of items. And I just want to touch on a few items. I can't obviously go through everything through this session, but hopefully you have considered these in your distribution calculations. If not, you'll have to consider them for your 30 June tax returns, and consider also unders and overs subsequently. So on rental income for REITs, if you have REITs and you're going through the process of your negotiations with tenants with respect to rental relief, there's a question as to how much of that rental income should be included as assessable for 30 June, how much can be excluded. Generally, each of the states have their mandatory code that they're going through negotiation with tenants, which are highly dependent on whether the tenants are small business entities and whether they can claim JobKeeper as well. To the extent that there is relief that has been provided, what would generally be the case is if there's a waiver provided under those provisions, we would generally say it's not accessible at 30 June. To the extent that deferrals have been granted, unfortunately, our view would be that the deferrals are likely to be assessable income still for 30 June, irrespective of your accounting treatment of those amounts. So be mindful that those items, there's some cases on this, that those items could still be assessable income. To the extent that you're still going through negotiations and claims have been made by the tenant, but you haven't finalised those, there are abilities to reduce the amount of income still included. For example, in the Victorian legislation, at least 50% of rental reductions need to be by way of waiver. There are arguments to exclude up to 50% of that as accessible income for 30 June. The critical item here is to make sure that you have considered the treatment and have a position. This can be a material item for REITs. So if you are trying to reduce your income, you do want to have at least an arguable position around your treatment there. I'll jump to interest income. So interest income, if you are a debt fund and you have loans and there are questions in terms of recoverability, there are some provisions that can turn off interest in respect of loans. For non-TOFA taxpayers, is what we call a non-accrual loan assessment under a taxation ruling the ATO has, which can turn interest off on certain loans. And under the TOFA provisions, when you have an impairment event, you also can turn interest off. There is an ability to go back in time to do that as well, and there's some ATO interpretive decisions on that too. So if you haven't made that assessment and you're bringing to account interest income that might not otherwise be collected, you may want to consider whether you can reduce your interest income. Where you've invested in other funds that have similar type of income, obviously you'll be attributed taxable income from those funds. You're not getting the underlying income, you're getting a trust distribution. So you need to be mindful of the exact treatment that the underlying funds are taking with respect to their income. You should also be considering any other income that you have received during the year as to whether it's derived or not, and how you're treating those. which comes down to the last item there. To the extent that you have to include the income, then you may be able to get a bad debt deduction, which is different to impairing the asset for accounting purposes. There are specific rules around bad debts that the ATO have. For example, you have to authorise a write-off before 30 June in most occasions. And if you have a trust distribution, the ATO does not agree that you can have a bad deduction on a trust distribution, unfortunately. So that you just need to be mindful of specific rules if you are claiming bad debt deductions. This flows on to the next item in terms of distribution. So if we're looking at what a trust needs to distribute, most of them have within their trust deeds a definition of income. Generally speaking, there's two types. There's a definition that broadly links to the Tax Act, which is on the left side, and a definition that broadly links to the accounting profit, which is on the right side. And generally, there's discretion to determine a change in that by 30 June each year. Now, this is not AMIT or non-AMIT specific. A lot of AMIT funds have a definition of income, and if that income isn't changed by 30 June, it also mandates a distribution to unit holders based on their proportional entitlement to income. So you do need to be mindful of what your exact definition of income is, because accounting profit and taxable income can be very different for this 30 June. And the COVID impacts on both the two can be very different as well. And in 2 slides, I'll go through an example that demonstrates that. But for those of you that haven't been looking at the exact wording of your definition of income in the trust state, I do suggest you look at it. There have been a few funds that have been surprised by what they have got as their wording in the trust deed and what they may have otherwise had to have distributed at 30 June if they haven't resolved to change that prior to 30 June. It is too late to change that now if that has not happened. So assessing the impact of COVID for trust distributions, and this is broadly touching on some of those items, as a starting point, you do really need to be critical around your accounting and tax timing differences, because there can be very large timing differences. The treatment of rent relief, disputed income, provision for doubtful debts, impairment of assets, all of those things for accounting purposes are treated very differently for tax purposes. And we have seen a lot of timing differences for tax purposes for this 30 June. We've seen a lot of funds that have huge taxable income and don't have a lot of accounting profit as well. And the next example on the next slide will demonstrate the impacts of that that may not have been picked up on distribution reviews. We're also seeing that a number of funds have had a number of impairments raised in their balance sheets, which have taken their net asset position downwards as well. And in those cases, those funds are still, when they're reporting losses, for example, in the fund, are still required to distribute amounts under the trust deed because they do have income of the trust for the period. So just keep in mind that you may even have a reduction of assets, but still be required to make distributions for the year. And finally, we're just highlighting that there are requirements under most managed fund trust deeds that you need to pay your distributions by a period of time. Just for tax purposes, if you're not an AMIT, you do need to have beneficiaries have a legal entitlement to the distribution for the income to flow through and taxable income to flow through. If you start putting restrictions on present entitlements or distributions, that can jeopardize whether you do have a present entitlement and whether the income flows through and taxable income flows through, which can create risks on trustees being assessed. So if you start placing restrictions on entitlements, such as you're not going to pay them, be very mindful that you can have you can have issues around trustee assessments in such cases. It is much better in terms of trying to look to refinance those distributions, even through the unit holders. There are some other issues that may come up if you do that with unit holders, but there's probably less issues if you've only organised to do that post 30 June. So please be mindful, restrictions on distributions can cause issues. So going back to this discussion about differences between accounting and taxable income, just by way of a simple example to demonstrate, assume that we've got some income that's both assessable for tax and accounting. It's $100,000 in each case, but then there's a few provisions that are raised for tax purposes, for accounting purposes that don't give rise to tax deductions, provision for doubtful debts, impairment of investment assets, an expected reduction in rent relief that hasn't resulted in an agreement at 30 June. Such that your accounting reports a loss of 32,000, taxable income of 75,000. Now, the amount you need to distribute for the year will be highly dependent again on your definition of income, if you've got an accounting profit definition or a taxable income definition. If you have an accounting profit definition in your trust deed and you haven't modified that prior to 30 June or made a resolution to change that prior to 30 June, unfortunately, you might not have the income of the trust estate to distribute, which if you're not an AMIT, the trustee could be taxable on the 75,000. So again, as I mentioned earlier, please have a look at what your trust deed says around what is the distributable income of your trust. If you have a taxable income trust deed and that requires you to distribute the net income of the trust, then there would be a mandated requirement to distribute 75,000 again, unless you've done something prior to 30 June to change that quantum. Now, irrespective that you've got a loss of 32,000, you would still need to record a distribution of 75,000 through your financial statements if that is the amount you do need to distribute. So again, just a very simple example, and hopefully you've gone through that process through your 30 June distribution reviews. We have seen some funds that have missed some of these issues where we've had to have a look at those during our distribution reviews of a number of the funds. It was great to hear Matt's side in terms of the net asset valuations that are occurring. For tax purposes, some different issues happen around this as well. Most funds have what we call a NAV requirement, so that can be a fixed trust. This is specifically important for non-AMIT trusts. There's special rules that say that you have to do your issues and redemptions at the net accounting value in order to be a fixed trust, both for the trust loss provisions and for flowing through franking credits. Now, obviously, and at this period of time, there is some uncertainty as to what is the value of units, and Matt went through that in a lot of detail. So what we're seeing is if you are doing redemptions, issues, or distribution reinvestment plans, and you are uncertain around those valuations, you could jeopardize your fixed trust status if you aren't valuing units at the appropriate accounting values. And one thing to keep in mind is if the auditors then put a qualified audit report around valuation in your financial statements around value, and you've still done these transactions, again, you could have a significant issue around this, especially if you're incurring losses and you need to be a fixed trust to carry forward those trust losses. So please be very careful. We've seen a lot of funds just put on hold a lot of these activities, including distribution reinvestment plans for 30 June. So it is something that you should be thinking about and considering. So just moving on to some non-COVID related issues and some key issues on some upcoming legislative changes, and just a bit of an update, very brief update on some of these items. The first item was on 30 June, there was an announcement by the Assistant Treasurer that they're going to defer the start date for removing discount capital gains from managed investment trusts. If you're not aware of this change, all it's doing is saying that the managed fund won't be able to claim the discount at the fund level. It'll pass on the capital gains to investors, and they will need to claim it at their level. What this means effectively would be that currently you can claim your deductions against the discount capital gains, so it almost doubles your deductions. This is management fees and anything for negative gearing. Once that change happens, you won't be able to claim that. That was due to start 1 July 2020, so a couple of weeks ago. They've now resolved not to start that, and it will only commence 3 months after the date of royal assent of the enabling legislation. So that's a good announcement. It provides a bit of certainty around this area. The second item I want to highlight is that at a recent Tax Institute forum, the HO had come out and said that it's going to increase its scrutiny over the classification of funds as either a MIT or an AMIT in Q3 and Q4 of the 2021 financial year. Now, this may be delayed due to COVID and the resources around COVID, but we're expecting towards the latter part of the year they start reviewing this. Now, the MIT classification is very important for the capital account election, to be an AMIT, to get access to being a fixed trust for AMIT purposes or for MIT purposes, to enable franking credits flow through and to get reduced withholding tax rates, just to name a few of the concessions. So if you are dependent on those items and you haven't done detailed reviews of whether you are a MIT under the legislation, which includes all the criteria plus an analysis of your investors to make sure you pass the closely and widely held tests, then I strongly suggest you be looking at those requirements in a review in the upcoming months. The next slide is just to give a brief update on the foreign hybrid mismatch provisions. These were introduced with effect from 1 July 2018. 1 July 2019. So they do have effect for this 30 June 2020 income year. What these provisions look to do is to remove basically double benefits where you have international transactions. For example, if you are claiming a deduction in Australia, but the income is not otherwise accessible in a foreign jurisdiction. One of the common transactions that applies to manage funds, especially around the REIT space, is what we would call the deducting hybrid provisions. And what these provisions look at doing is denying a deduction where you're claiming a deduction for the same amount both in Australia and in a foreign jurisdiction. The slide indicates a common structure where the managed fund might invest in real estate property in the US, for example, using a US LLC, which is a flow-through vehicle, such that we may claim the managed investment trust may have checked closed, so it's lodging a US tax return. It may therefore claim deductions for the rental expenses in Australia, in the US, and will claim a loss under the partnership rules through Division 830 in Australia. So we're claiming deduction in Australia as well as a deduction in the US. If the deducting hybrid provisions apply, the $20,000 in the example here, which is the loss in year 1, would be denied in Australia, where you will not get access to that deduction, and you can't apply it against any other income that the managed investment trust makes. So if it does have, for example, Australian income, you can't apply that loss. You'd have to wait till the following year and determine whether you effectively have basically a position where the rental income exceeds the expenses in that subsequent period. In such a case, then you may be able to get access to the 20 grand loss that you have carried forward. So it is a bit of a watch out. We've seen a lot of funds have not analysed their foreign hybrid mismatch position, and it does affect their 30 June position. So if you have international transactions, it is quite important that you are considering those for this year. Just briefly, I just want to touch on public trading trust provisions. We've seen a lot more activity by the ATO around the public trading trust provisions. They are taking more stringent views around this. So under these provisions, if you breach the public trading trust provisions, your funds can be taxed like a company. Essentially, those provisions say if you're widely held, so 50 plus investors, directly and indirectly, and you don't carry on passive activities which are listed in those provisions, then you can breach these provisions. They're taking more stringent views around the controlling test. So if you hold interest in other entities and you hold a 25% or more interest, the ATO has issued a lot of PBRs recently saying that that will constitute negative control. And if the underlying entity carries on activities that are not permissible, it will blow up the fund essentially, so it'd be taxed as a company. We've seen a lot of PBRs being issued by the ATO where they're taking stringent views on car parking operations for commercial buildings, such that if you're operating a car park and it's not effectively available only to the tenants or isn't primarily available for tenants, they're suggesting that that would constitute activities that aren't incidental to operating the REIT. If you are disposing of real estate, again, that is a high risk area, even if they include small proportions. So if you're holding it for a short period of time, or you're buying property and dissecting a component out and selling it, the ATO are taking more stringent views around what that means under public trading trust provisions. And finally, if you have other types of income being derived by the fund, that income can breach the public trading trust rules if it doesn't otherwise fall into the list of acceptable income. So again, please be mindful on your reviews for 30 June in terms of the other types of income, and on a go-forward basis, this is something the ATO is looking at more closely. My final item that I just want to touch on is we're now in the second year of the non-concessional withholding tax rules, and again, we're still seeing a number of funds that aren't picking this issue up. So just to remind you, there's 4 types of new income that a fund can earn that it does not get access to the reduced withholding tax rates to non-residents, which includes across staple income, trading trust income, agricultural income, and mid-residential housing income. One of the key ones that we're seeing is being missed is the mid-trading trust income. This is where a fund invests in another unit trust, and that unit trust is distributing income through. That income, if it breaches a trading trust rules, irrespective that it's not a public trading trust, has to be treated as non-concessional mid-withholding, non-concessional mid-income, and you don't get access to the reduced rate. Now, those funds, are, irrespective of what they are, they're supposed to be giving through fund payment notices to disclose what type of income that they have. So if you haven't been requesting that or looking at that, you should be looking at that so you understand exactly the types of income flowing through. So it is something that we're seeing that is being missed. So that was a very quick tax update. So I've flown through that. I will now hand over back to Matt and Elliott, who will look at the questions that have been raised and answer some of the questions in the remaining time on their side, and then I'll turn over to me to answer some tax questions if there are any there.
Okay, it's Matt here. Thanks, Alexis. I'm just having a look through. There's a question here. What if this is a valuation related question? What if the underlying assets of the unlisted fund are first mortgage loans and not direct property? How to value underlying assets when some are valued as if complete and are construction facilities, which is a good question. I'm obviously not a valuer, but I would say that in the current environment, your valuation methodology and principles shouldn't really change. So you should be following the same valuation policies and methodologies that you'd follow anyway. So if you're valuing underlying assets of a borrower you've lent to on an as-if complete basis, which is pretty common for a construction type loan, then you'd still be doing that in the current environment. The question is though, can you get independent external evidence? Can you get an external as-if complete valuation to back up that value that you want to rely on? And again, the issue is, particularly in the current environment, what are some of the disclaimers that might be in that valuation that's provided to you that may make the valuation uncertain, or you might decide that as trustee the valuation might not be suitable to rely on. So you'd be following the same method of valuing the underlying property on an as-if complete basis, but the recommendation would be, particularly at the moment, to still try and get an external valuation, as-if complete valuation, and just be careful to make sure that what they're saying in there isn't so qualified or uncertain, so as to render it potentially dangerous to rely on.
Sorry, this is Elliott speaking. I've answered the question in the questions section, but just to clarify for everyone, if you'd like a copy of the ASIC COVID-19 question there that I mentioned during my talk, feel free to send an email to me using my contact information on the last slide, and I'll just hand over to Alexis.
That brings us to the end of this session. So again, I'd really like to thank Cliff Clayton and Paul Dorfkamp for the opportunity to present on behalf of Pitcher Partners and McMahon Clarke for the Compliance Forum. I'd like to thank both Matt and Elliott for their fantastic presentation and for all of you joining with us today through this session.